mind when you earn money or pay for goods or services is that there's almost always a tax associated with it. Some of these taxes will already be calculated and added or deducted for you. For example, when you check out at a store, the store calculates the sales tax when they tell you your total, and then they are responsible for paying that to the government. However, there are some taxes that you're responsible for. For example, if you own your own business, you will be responsible for calculating and paying your own income taxes. Also, you're responsible for telling your employer how much you want them to withhold and pay to the government for your income taxes.
Some examples of taxes you'll have to pay as an adult include the following. When you want to buy things, you'll need to pay sales tax, although some states have exceptions for things like standard groceries and clothing. If you're employed by a company or are self-employed, you'll have to pay income tax, Social Security, and Medicare. Just an interesting note that for some professionals, like athletes and recording artists, they actually need to pay a percentage of their annual income to each state that they played in, based on how long they worked there. If you want to buy something like tobacco or alcohol, there are additional taxes as well. And if you own your own home, you'll need to pay property tax. There are many other taxes, and it can sound overwhelming at first, but most of them are automated, which is convenient and makes things much easier on you.
When you get a job, you'll receive a paycheck. The frequency of your checks will depend on the company you work for. Some companies pay their employees every week, some pay their employees once a month. The most common, however, is for them to pay their employees every 2 weeks. This is also known as bi-weekly payments. The amount that you receive in your paycheck will also depend on several other factors, including if you're hourly or salary, how many hours you work each pay period, what your pay rate is, and how much needs to be deducted for your benefits and taxes. The first three go hand in hand. If you're paid a salary, then your yearly pay is divided evenly between the pay periods, and you generally receive the same amount with each paycheck.
If you are salaried and paid monthly, you calculate your pre-tax income with this equation. Your pre-tax income equals your annual salary divided by 12 months. If you are salaried but are paid bi-weekly, you can calculate your pre-tax income with this equation. Pre-tax income equals annual income divided by 26 pay periods. Just a quick note. You'll notice throughout this series that we divide by 26 pay periods and not 24. There are 2 pay periods in a month and there are 12 months, so that must mean 24 pay periods, right? Actually, because of how many days are in the year, 365 days, each month ends up a little more than 4 weeks long, so it doesn't perfectly divide into 2 pay periods per month. Every 5 months or so, you'll actually have 3 pay periods. That's why you'll see us dividing by 26 throughout this program whenever we talk about bi-weekly paychecks, instead of 24. Back to income. If you are paid an hourly rate instead of salary, the amount that you earn each paycheck will depend on what your pay rate is and how many hours you work during the pay period. This means that for hourly employees, their pre-tax income is calculated by pay rate times hours worked in a pay period. For example, if someone makes $10 per hour and works full-time, which is 40 hours per week or 80 hours per pay period, their pre-tax income will be about $800 per paycheck. However, that does not mean that that's how much they will get in their paycheck. There are 2 things that the employer has to deduct from the amount that they earned. The first thing is taxes. Your employer has to deduct a percentage of your pay for state income tax, federal income tax, Social Security, and Medicare. You might receive some of this back around tax time depending on how much you ask your employer to withhold. The second thing they need to deduct is your benefits. If you receive any benefits through your employer, they'll deduct your contributions from your paycheck. Depending on what particular benefits your employer offers, this could include anywhere from medical insurance to dental insurance, vision insurance, additional short or long-term disability insurance, life insurance, a health savings account, a flexible spending account, a 401k, or more.
It's a lot to think about, but luckily, like with most taxes, much of it is automated, so you don't usually have to worry about them. Flip to example 1, paycheck and pay stub, for an example of a paycheck for a person who works full-time, makes $10 per hour, and is paid bi-weekly. As you can see, the employer provides you with a breakdown of all of your deductions, but they do all of the work on their end, so you can take your check, deposit it, and go on with your personal business. If you have any questions about things like income or taxes, you can always visit the IRS website. Continue these lessons with Session 5. What is credit?